What's the road ahead for the U.S. economy, and how will Obama's second term pan out? For expectations on how that will all play out, we are now joined on the show by Arvind Sangar, who's managing partner at Geosphere Capital Management in New York, and Jeremy Stretch, who's head of FX strategy at CIBC, who joins us on the show from London. Arvind, I'm going to start with you. What does Obama's re-election mean for the U.S. economy?
Well, I think the one thing that it means is that Fed policy is going to have some continuity, and that's what's driving global liquidity. So that part, I think, is the easy part. The other part that I think is more difficult to call is how the whole discussion about the fiscal cliff will be resolved. And I think there the issues are, with the Republican Congress and with the Democrats controlling the Senate and the presidency, there is going to have to be some give and take, and what form that compromise takes, how much tax increases come in, how much spending cuts come in, and how quickly they come in, is something that the market's going to be watching with great keenness, because that will determine how much of an impact that will have on 2013 economic growth, because there's going to be some amount of fiscal tightening. How much is what remains to be determined. So I think that, I don't see any dramatic changes, given that it's, pretty much a continuation of the status quo from before the election. But I think there are some unresolved issues on which there could be some debate in Washington, and I think that will determine, how things play out.
Jeremy, what's your sense? Obama gets a second term. As far as equity markets are concerned, is this good news or bad?
Well, I think the most important thing is that we've cleared up the electoral uncertainty, and I think that was obviously one of the risk parameters going into the event, certainly as people were talking about it being too close to call. We haven't had a rerun of anything like the post-election outcome in 2000, so I think that's the encouraging thing. Ultimately, of course, despite the months of campaigning and the billions of dollars spent in advertising, we still have essentially the status quo. And I think from a market's perspective, that probably has seen some a little disappointed that we're not going to get the lift in equities, or in certain equities that we might have assumed. But ultimately, I think the clearing out of the uncertainty is probably the most important dynamic now that we've passed through the election process.
Jeremy, some market experts predicted a 40% correction for global equities post-Obama's win. Would you be as pessimistic?
Absolutely not. One would imagine that somebody making that sort of forecast certainly had a fairly large political axe to grind, as well as an economic set of assumptions. I think there is a risk that, well, the assumption would be that the perpetuation of Fed policy being very easy might be more favourable for bonds than it would be for equities. But I don't really see anything other than at the margin of some small residual uncertainty in some of those stocks that would have been best supported by a Romney victory. I think the ultimate case for equity markets now, and certainly for North American equity markets and the S&P in particular, is the underlying dynamics of the US growth story, and I think that remains reasonably encouraging. So I think that should be the defining factor in terms of equity performance in the upcoming days and weeks.
Arvind, how do you see global events shaping up in 2013?
Well, I think in the next 12 months, Europe will continue to remain an issue, but I think U.S. fiscal policy might become somewhat more important. And I think China, what it does in terms of the new, regime or the new leadership that takes over in China, how they effectuate change, how slowly or gradually do they try to, impact their growth trajectory. To me, those could be some of the, more meaningful events of 2013 on a global basis. I think Europe will remain a problem child, but with periodic outbursts of crises. But with the ECB standing there, I think the meltdown scenario may be off the table, but the crises in Europe will, we will continue to lurch to mini crises, but hopefully not a major blow up.
Jeremy, the euro was under some pressure against the US dollar in the run-up to the US elections, but do you believe it will head lower from current levels? Where do you see it at by the end of this year?
Well, I think, of course, we've now cleared away one piece of potential uncertainty in terms of the election. So I think that now leaves the market once again to refocus on the events in the Eurozone. And those events are not looking particularly comfortable when you look at the relative fundamentals, because the economic data that we've seen of late, particularly in terms of those service PMIs and in terms of some of the real economy data in Germany, have proved to be very, very worrying. And I think that just underlines the fundamental weaknesses that are akin in the Eurozone. And of course, we still have the politicians in Europe essentially frittering away the time that the ECB gave them with the announcement of the OMT program back in September. So I think that does risk euro negatives playing out, at least in the short term, and I think that risks euro fragility once again coming in. We may well find ourselves back in the 127 area. But by the time we get to the end of the year, it may well be the case that we do see a little of an uplift. That's perhaps not a function of an improved degree of sentiment regarding the euro, but it's probably more the case that the dollar tends to perform rather weakly on a seasonal basis in December. So it may be the case that November is a rather poor one for the euro, and it may be the case that we do see a little bit of a reversal, largely on the basis of capital flows into year-end, which might well see us back towards the 129, 130 area at the end of the year.
Arvind, let's talk about India. You know, a word on India. 2012 hasn't been a stellar year for the stock markets here. Do you see a breakout for equities here on?
I think, you know, once the global so there were two risks that India had earlier this year. One was the global meltdown risk. And that, with the central bank and, you know, global liquidity, flight of liquidity out of India, because India is very dependent on foreign flows, as we all know. So now that liquidity fear, I think, is gone away because of US Fed and the ECB have opened the checkbooks in a big way. Then once those liquidity risks off the way, that's one reason why the Indian markets are having a new bull market. But where they go from here, the policy paralysis and the meltdown in the economy because of policy paralysis, that risk has also turned somewhat more, less concerning with the current finance minister, Mr. Chidambaram, having taken a number of actions to at least signal to investors and to company managements and others that the government gets it, that there is need for government action. So I think a risk of a meltdown to where we were earlier in the year, earlier in 2012, is unlikely. But where this market goes from here into a new bull market in terms of crossing past or getting back to previous highs, I think that's going to be dependent on a number of things that are India specific too, in addition to the global factors we just discussed, and those would have to do with ability to actually execute and follow through on some of the initial good flurry of actions that the finance minister has taken.
Arvind, of course, for the year, India has been the best performing market amongst the BRICS. Do you see that continuing?
India is, whatever term one uses, the tallest midget, the, one-eyed man is king amongst blind men. That has clearly been India's case. And I think the real issue for the other BRIC countries is really China. And they're much more dependent on China re-accelerating. So to the extent that 2013, one of the bigger risks to India's relative outperformance is if China becomes somewhat more attractive after its leadership transition, and if they are able to follow through with some strong, sustainable actions over the next few quarters, then China becomes more attractive, and if China becomes more attractive, then Brazil and Russia become more attractive. And those would be the circumstances in which India would not be the leader but could be the laggard. On the other hand, if China remains, almost feels like shut down for business, but if China remains in a state of transitory flux as a leadership change, the new leadership is trying to consolidate its power. If that remains the circumstance, then the BNDR, Brazil and Russia, could struggle along with the Chinese market. In that case, India could continue to be one of the better performing markets, and certainly one of the better performing markets in the BRIC countries.
And lastly, Jeremy, which emerging market currencies seem most attractive to you?
Well, I think if we do take the assumption, as we do, that the US or North American economic story remains relatively well supported, certainly in contrast to that in the Eurozone, and whilst we're still looking for a deceleration to be perpetuated in Asia, then I think in the emerging market space, then that probably leaves the greatest opportunities in those currencies which are leveraged off the North American growth story. So I think that leaves a currency like the Mexican peso looking relatively well served in terms of the risks of appreciation. I think the CPI story probably encourages the central bank to be a little more hawkish than the majority of other central banks as well. So I think that makes a good case for an undervalued Mexican peso to make some reasonable gains. I think it also probably suggests that the Brazilian real, despite the perpetuation of the authorities to try and limit its gains, may well also have a little bit of further upside, largely because of the rising inflationary pressures there, which could be at least partially alleviated by allowing a slightly stronger currency.
Right, Jeremy Stretch and Arvind Sanger, both of you, thanks very much for joining us on the show with that outlook on the outcome of the US elections and also the outlook on the global markets.